The biggest retail brands in America, Amazon, Nike, and Starbucks, are telling us more about the economy than the Fed right now. And nearly all of them have been quietly underperforming the market. In this episode of the Dean's List, we're going to break down exactly what these stocks are signaling for you as an investor and why your portfolio is ignoring the message. Plus, I'll show you how to use this data to get ahead of the next market move. I'm Dean Lilkin, investing veteran and private credit CEO. As usual, here to help you grow your wealth. I want you to stick around because I'm going to walk you through 5-year performance comparisons, sector weightings, correction analysis, historical outperformance patterns, and what macro triggers to watch. Most people will miss the signal when discretionary starts flashing. This isn't just about stock picking, it's about reading the market's handwriting. US consumers are still spending, but more on experiences like travel and dining than goods. Credit card balances are near record highs, and defaults are starting to tick up. Value-driven retail is outperforming. Think Walmart and TJ Maxx, while mid-tier struggles. Inflation-adjusted goods spending has been flat or declining since 2022, the last major correction. The largest consumer discretionary names, and I'm excluding Tesla because it carries such a huge weight and isn't really a consumer discretionary stock. I think of it more as technology. But think Amazon, Home Depot, McDonald's, Nike, Starbucks, Booking, TJ Maxx, and Lowe's. The 1, 3, and 5-year absolute and relative performance is very mixed. For Amazon, you're talking about plus 10% over 1 year, plus 80% over 5. That's slightly underperforming the S&P 500. With McDonald's, you're talking about only up about 2% over the last year, up about 56%. Strong relative performance. Home Depot, down 6% in the short term, up 64% over longer periods, but recently lagging. Nike, only plus 40% over the last 5 years. A sharp underperformance, likely linked to very specific factors unique to Nike, not necessarily the sector as a whole. And Starbucks, negative over 1 year, up a little bit over 3, and up 35% over 5. Weaker recent momentum. Now, the current correction that all of us are still in the middle of, the discretionary sector, the consumer discretionary sector, is down about 12%. It's drastically underperforming the S&P 500. Look under the hood. The equal weighted S&P 500 consumer discretionary is only down a couple points. Still worse than the index, but much better. And why is that? That's because Tesla and Amazon carry such enormous weights within this sector. And if we flatten out the weights and give each stock within consumer discretionary the same weight, we experience a completely different set of returns. And as usual, I implore you to dedicate a part of your portfolio to equal weighted indexing as opposed to cap weighted indexing. It gives you a much better feel for what the average or median stock is doing within a sector or an index than the index performance as a whole. Now, today, the sector weight in the S&P 500 for consumer discretionary is around 10%. Importantly, that's down from about 12.5% about 10 years ago. Next, let's break down when this sector tends to outperform and the exact macro conditions that trigger a comeback. Retail and consumer stocks tend to historically outperform in late cycle to early recovery phases. Post rate cuts or when rate cut expectations are rising. We need consumer confidence to be rebounding or seeing some kind of tax cuts or rebates going on. It underperforms during tightening cycles. Makes a lot of sense. When energy prices spike, right? It's oil sensitive. And when unemployment expectations rise. Again, very sensitive to the consumer and their spending patterns. The key triggers for you to watch are real wage growth, inflation expectations, falling is bullish for retail margins, Fed rate pivot signals. It can be a leading indicator. The consumer discretionary sector includes stocks that depend on non-essential spending. Think restaurants, apparel, travel, and electronics. When consumers pull back, these companies often feel it first, before industrial production or employment fully rolls over. So, if this sector underperforms the broad market, especially during a rising market or when other cyclical sectors are strong, that divergence can be a red flag. Let's look at some historical examples. Going back to 2000 to 2001, the discretionary stocks peaked in early 2000, months before the broader market. Underperformance persisted even as tech was crashing, foreshadowing a broader economic recession in 2001. Think back Great Financial Crisis, 2007-2008. The sector rolled over before the official recession began in December of 2007. Discretionary underperformance began as early as mid-2007, signaling stress in consumer behavior before jobs and GDP data confirmed it. And looking at the 2022 2022 bear market, consumer discretionary underperformed sharply in 2022 as inflation surged. Though no technical recession occurred, the underperformance reflected real consumer pressure, elevated credit card use, eroded savings, and demand destruction for goods. Individual investors tend to overestimate their ability to make predictions about consumer stocks. Why? Because unlike industrials, materials, or other difficult to understand sectors, including financials, consumer stocks are companies that we interact with on a daily basis. We eat there, we shop there, we buy their products all the time, whether it's online or in person. So it's very important to stay very, very humble about our ability to predict any trend about a sector that we know we're going to be overconfident about. Underperformance alone does not guarantee recession. Underperformance of the consumer discretionary sector has probably predicted 2 to 3 times as many recessions have actually happened. And a lot of times this happens during corrections, which we may be in right now, right? This may not be the prelude to a bear market. It can reflect sector-specific issues as well. Think Amazon or Tesla. Tesla had a huge run-up post-election. Now it's hard to even call it anything other than crashing. And it's dragging the entire sector down because of the enormous weight that it carries, because of how enormous the market cap is for Tesla. And same goes for Amazon. Relative performance to consumer staples can be even more telling. When discretionary underperforms while consumer staples outperforms, it signals risk-off behavior and recession fears are in play. Here are some useful metrics for you to watch. Using XLY and XLP ETFs that tell us about the consumer discretionary and consumer staples sectors, we can look at the ratio of the two together. You can put them on a simple chart in Yahoo Finance or Google Finance, and you'll notice that when they're falling, when consumer staples is leading and consumer discretionary is lagging, you're clearly seeing a signal for rising recession risk. Another indicator worth watching is the Conference Board of Leading Indicators, the LEI, as well as the University of Michigan or Conference Board Consumer Confidence Measures, and personal savings rate and revolving credit trends. None of them alone will tell you anything, but together they can start to paint a picture, and the longer that picture gets painted, the more valid it becomes. We're still very early in this current downtrend, and jumping to conclusions like whether there's a recession coming up or whether this is a bear market, it is much, much too early. Bear markets develop over 18 to 24 months. They do not peak and trough in 1, 2, 3, or 4 months. Bottom line, sustained underperformance of consumer discretionary stocks in 2025, especially relative to staples, often precedes economic slowdowns. Not a perfect signal as we discussed, but when combined with other macro indicators, it's a valuable canary in the coal mine. Here's our key takeaways. Look for margin strength and consumer behavior shifts. Amazon and McDonald's are strong bets. And you know what? Nike could be a longer-term turnaround story. Discretionary names tell you a lot about economic optimism. Ignore them at your own risk. I want you to subscribe to the Dean's List for more clear frameworks to build your portfolio. Thank you for watching.